Hey everyone. Hope you're having a great start to your week. Happy Taco Tuesday. Although we're not really having the kind of tacos the market may have wanted, but nevertheless, bouncing off its lows on the Nasdaq. Dow really never looked back. It's up about 1.17%. And the S&P 500 up about 1/3% here. So market's a little bit more resilient than many would have expected after the price action we saw overnight from South Korea. There's been, and the Nikkei as well in Japan. There's just been a lot of talk about how we could continue rolling lower. And with the way the charts look, especially on the NASDAQ, that's not an out of the range of reasonable possibilities scenario. But nevertheless, we're looking at the intraday action right now, and it's looking like a nice little recovery here and probably going to consolidate. So let's get into the slides. First one's first, always manage your risk. Manage it first and foremost before anything else, because if you want to survive at the game of trading, you absolutely have to manage that risk. And I'm going to show you why in a moment. First, just a little bit about me. So not to date myself too much, but I've been doing this for about 21 years. I trade my own money. I don't use prop firms. I don't believe in prop firms. I think their business model is to extract as much money from you as they can. If you're not able to trade your own money and that's the sort of Band-Aid fix you're taking, please be advised that they widen spreads. They delay order flow. They'll do other kinds of tricks to make sure that even if your trades are good, you don't get the payout you deserve. That's really what their business model is built on, is extracting money from you and making sure you don't get payouts. If more of their customers get payouts, the firm itself may no longer be able to sustain itself. Oh, and yeah, I see that. All right. No worries. Not missing too much here. Let me go ahead and get the video live. That's probably the right screen. Let's see. Yep, it is. All right. Thanks for the heads up, Stephen. All righty. So back to the brass tacks of doing business in this market. Really, at the end of the day, the biggest mistake that people tend to make is going all in. There was a post on Twitter I saw of a guy who allegedly, we never know if these things are true, if it's just for attention, but allegedly built his account from several $100,000 to something like $15-20 million or so, and now has a drawdown where he's back in like the 7 digits. God forbid. But you've got to look at stuff like that. And at least, even if you're not taking it fully seriously, there's a lesson here. Leverage cuts both ways, and it cuts much, much faster and harder on the way down. So if you're on the wrong side of a trade, you keep doubling down on it, thinking you're right, it's just getting a discount. And then eventually you start getting longer and longer to the point you're using, reg margin or portfolio margin. You're putting more of your account at risk than you think. And you can get to a point where you're totally wiped out. This is why I like to tell people, try to avoid the fourth shape, which is the portfolio gone. Because this is something that almost every trader experiences once. Some even refer to it as a rite of passage. I would strongly disagree that it is. I think managing your risk properly from the get-go is actually going to help you a lot more than going through a complete drawdown and learning about it from the depths of despair. The other part is, as you're learning to trade, it's really important not to do too much all at once. So let's say you've got a net worth of $100,000 in liquid assets. You shouldn't be putting that all into your trading account. You should maybe look at, if you're new at this, maybe just a few $1,000s, especially now that pattern day trading is no longer really a thing. You don't need to put as much capital at risk to be able to trade the daily tape. And there's another mathematical reason for this why, and I do this every week. I have a sermon on risk management. I do it for one, Big reason. I seen so many people fail at this game because they fail to manage their risk. And I don't want that to be you. Whether you're tuned in live or watching the recording later, I'd prefer that you're able to sustain and determine whether this is the right path for you without going through the mess of just blowing up your account. The other thing I think is really important is pace yourself. Don't set your expectations in an unreasonable way. If you think you're just going to quit your day job, become a really successful trader, drive a Lamborghini to, whatever, like maybe tone that back to, let me get my win rate above 50%. Let me have my winners be bigger than my losers consistently. Like once you get to those metrics, then you can start dialing up your expectations a little more, but you've got a whole other set of gates you have to go through, okay? And that means if you're trading S&P futures, you need to beat the index. That's your benchmark. You also need to adjust for slippage, any kind of commissions or fees, and short-term capital gains, as well as your data subscriptions, any of the product subscriptions. All that needs to be netted out of your profit. And then you need to determine in an honest, objective kind of way, am I beating my benchmark consistently? Week over week, month over month, year over year. If you're not, you've got to sit down and have a difficult conversation with the inner trader and figure out whether you are able to take it to that next level. One thing that I will never do is mislead people about the odds, because I find that once you get into the mindset of thinking this is easy, that's one of the most dangerous mindsets to be in. I'm going to tell you straight up, this is going to be hard. It's going to challenge you. It's going to be one of the hardest things you've done psychologically, because all of the worst traits, all of your impulses, your fear, your greed, it'll all be exaggerated, and it'll be exaggerated at the worst times, which means you have to get that stuff under control. The path towards getting it under control, reducing the impact of emotion on how you perform, is taking a more systematic approach to your trading. Backtesting, generating signals, understanding when it is time to get involved with the market, and not just trading to feel something, as so many do and get hurt doing. This all matters. It's all part of your journey, treating this more like a business than a hobby, because it does deserve that respect. You're buying and selling inventory. You're hoping to capture a positive spread more than you're not. You don't need to dress it up to be something it isn't. That's exactly what it is. You're running a business when you're buying shares, futures, options, whatever. That's inventory. And you're trying to sell that inventory at a higher price. Or maybe you're borrowing someone else's inventory. You're shorting, right? And then you're trying to buy it back at a lower price. Either way, you're trying to capture a positive spread on either side. That's the goal. Don't overcomplicate it, but don't reduce it into being something less than it is. It deserves your respect, your attention, and continuous commitment to learning and practice. The market started to get a bit rough in late May when everyone really was on the same trades. They were all concentrated. And once we started to see those metrics, I put warnings out there on socials that I'm on and on some of these streams saying, please be careful, folks. Everyone's loaded into the same stuff. It's been tumultuous since then. June, we saw some consolidation and then more of a structural breakdown as time's gone on in this summer. And this is especially confounding to the seasonality folks who are like, but wait, July is always supposed to go up. Seasonality is really just looking back in time and mapping out what often happens for all variety of reasons. It's not destiny written in the stars, though. It's just probabilities. That's the same thing with backtesting. You're not saying, boy, I got this backtest. It's got an 80% win rate. How could I go wrong? I have to just go max. No, there's still a 1 in 5 chance you're going to get blown up on that trade if you don't manage your risk. And that's just based on the backtest. Forward looking, those variables can shift, especially if the regime you're in shifts. So I mention all this because I want to set your expectations in a way that are reasonable. I'm pushing back against a lot of the narratives that this is really easy and you just join some service and they just tell you what to do and now you're a multimillionaire. It really doesn't work that way. You need to learn how to manage your own trades, your own portfolio, your own risk. Services can be helped to learn, help you learn how other traders trade, help you learn about signals, and, maybe meet a community of other people that help to expand your horizons. You can join those and get value out of them if your expectations are reasonably dialed in. But if you're expecting, I'm just going to join this thing and I'm going to become rich and I don't have to put any effort into learning anything, you're going to have a bad time. It's about developing your own strategy, but it's also about using that strategy consistently. If you wake up, you do your daily routine, you get ready for the market, and then as soon as the bell rings, all that strategy goes out the window because impulse takes over, you're going to have a bad time. I could not be more real with you about this. It happens to a lot of people. They spend all this time doing work, figuring out, this is the indicator I'm going to trade against, this is the setup I'm going to use, etc. And maybe you've been here too. And then the market opens and all of a sudden it's just more about like, oh, wow, look at that move. I've got FOMO. I don't want to miss out on that. Or, oh, gosh, this is scaring me. I've got to dump everything. Like, it really, you've got to make sure you're taking a more structured approach. And you've got to turn that from being a routine to a behavior. So if you get up and you start working through your strategy during the trading day, and this is the first or second or third time you've ever done it, you'll find yourself slipping. Behaviors don't get set overnight. So you can give yourself some wiggle room on that. Oh, you could say, oh man, I'm getting out of my lane here. I need to either take a step back or just go right back to my strategy. If you have to take a step back and take a break from the tape, that's fine. In fact, I would encourage people to do that more often than they do. This can be mentally taxing. You've got to give yourself that ability to recharge your battery because you got to be in your best shape to make rapid decisions and the best ones possible in a short period of time, which means you have to be recharged for it. So that's the other part about it as well, is you have to kind of do some basically reflection. How much time do you want to spend staring at your screen? How much does that tax you? How much is the opportunity cost of doing that versus doing something else? And what it ends up coming down to is if you start building signals around events that help to you say, hey, this is a trigger for a trade setup, you could save some of that time and be doing other things that can also help your journey in trading or just in life. So again, when you wake up and you do your routine, you prep for the market ahead of you, take a moment before you start trading to reflect on your strategy. When you enter a trade, when you exit a trade, make an entry in a journal. It can be simple, but it should have at least the time, the entry price or exit price, the reason or theory behind it, kind of what your mindset is while you're doing it as well. Are you doing it because a signal fired off? Or are you doing it because FOMO? You can start to learn a lot more about yourself reading that journal. Do it once a week. This will help you reinforce the behavior of sticking with your strategy. This is where the rubber meets the road, because you have the daily reinforcement of, oh boy, I really ought to do this, but also the weekly reinforcement of when I deviate away from my strategy, my trading probably isn't going as well. So that adds together reinforcement, both positive and negative, to ingrain this as a set of behaviors that you use to manage how you interact with the market. Let's talk about this week's pivots and really where we are in relation to them right now. So we are below that on the S&P, on the Nasdaq, on gold, and on silver. I don't want to be a Debbie Downer, but everything looks a bit bearish that we're tracking in these four assets. Oil is also cracking below $80 a barrel, so not a lot to love there. And on the long bonds and treasury note side of thing, we've got a little bit of a bid going on in the 30s and the 10s. That's helping to bring the yields down just a bit. I'm just going to check real quick because we had an auction today of 7 years, closest thing to the 10s this week on the dock. And it tailed just a little bit, 0.2 bips tail. Not terrible, but just a sign of waning demand a little bit here as rates have come down. And really quickly for folks out there, if you're looking for a good deal, we've got 20% off TraderAid plans. Use the code Mayhem20 at checkout at TraderAid.com and 40% off new customer discount for Bookmap. Visit TraderAid.com/Bookmap. Scroll down to those special offers. And we're going to go right into the namesake product here in Bookmap. And I want to show you something that occurs to me just looking at this chart, right? You know, I was in the slide deck. This screen has been hidden from me the whole time. Yet when I open this chart, immediately this catches my eye right up here. You can see a confluence event. 3 different things kind of happening at the same time. The first that stands out is you've got a sell-side iceberg in the Nasdaq of 143 contracts. That's some decent size in the Nasdaq. The second thing that stands out to me is that we saw buyer exhaustion here. There was some aggression. We tried to push up to the point of control, and we didn't even get there. We were rejected. You had a passive seller come in and dump into that buyer exhaustion. Okay, so that also gave you kind of a decent little setup for the fade. And then look at the order book. You've got a delta of 1.4 thousand on stacked offers. And what that tells you is that there are more sellers than buyers, so that makes the book look a little more heavy. So you put that all together, and what do you see? You see a market that reacted negatively to that combination of a large passive seller, a rejection of the point of control, and buyers getting exhausted, kind of sweeping and pushing in, trying to get back up there and failing. And then what's the microstructure here? I mean, you got to really zoom in to see it, but it's lower highs and lower lows. Okay, so that microstructure is a trend down in this very small time frame as well. So that just gives you a sense, you know, Nasdaq came off its lows, and it's still well off its lows here, but we are seeing sellers step in. Let's just zoom out a little bit more so we can see that bounce as well, because that was a pretty nice little bounce off the lows. And this is kind of tempting one of those double break Tuesdays here. You know, you had the opening range. We've clearly broken above it here. We also broke below it here, right? So really, we are seeing a double break Tuesday and now a reversal off the high. So you got to love that. Tuesdays have a 60% chance, excuse me, of piercing both sides of the opening range. Makes Tuesdays a good day to be careful about the duration of your exposure. I've found a lot of these moves tend to taper off after around 12:30. You can see that starting to happen here as well. The velocity was lost going into lunch. Now we might be reversing lower. So that's another thing to consider. Just, you know, what's your holding period? Are you looking just to be able to ride the trend to its absolute maximum extension? Or do you have some strategy you put in to map out your exit? Because what I've found for a lot of people in trading is it's very easy to get in. It's a lot harder for them to figure out where to get out. And if you find yourself in that position where you're like, okay, I know where I'm getting in. I just, you know, I want to get exposure here, but you don't know where your exit is, hit the pause button for a minute. What are you doing? Seriously, ask yourself that. What are you doing? If you know where you're getting in and you don't know where you're getting out, you're setting up for what could be a bad time. So I think it's important to contextualize that. Like when you're, you know, doing your trade journaling, what I also recommend, and this is kind of part of that whole, hey, let's have a strategy and let's use like a, you know, a system. Map what you think your exit will be. Like, are you getting into that trade blind? Or are you getting into that trade knowing this is where I'm going to get out if it gets there on the upside, or on the reward side, and this is my maximum risk. And by the way, you should have ratios mapped out for that too. And if all this stuff I'm saying sounds like a lot of math, it's because it is. It's not super complicated math, but it's math nonetheless. The ratio is the idea of you should be looking at your backtest or whatever the system is you use to plan your trades out, assuming you plan them. And if you're not, you're just gambling, so you should. You should know what reward you're targeting before you get into the trade and what your max risk is. And you should know the ratio between the two. Ideally, your reward is at least 50% bigger than your risk. At least. Should be even closer to like 75% or even 100%, where the probability stack there objectively. Don't curve fit to get there. And you can see that even though buyers made another push up here, they did get a bit exhausted. We saw sellers come in and absorb, and we also saw some stop runs happening. So price came down from there as well. The algos that trade this stuff can see this similarly to what we're looking at here. They can see when there's exhaustion, absorption, more aggression on the iceberg or stop side. This is all things that feed it. So why shouldn't we visualize it too as a part of our trade decision-making process? And you can't hear it because I don't want to spam the sound too much, but I have audio alerts for these things when they go off as well. So that helps me to be able to focus on different things and then go back to my screen when there could be a setup. So when I was talking earlier, I heard that exhaustion alert go off. I want to finish my point, but you could see how that kind of stuff can play out. And I think it's important to kind of get disciplined enough that we're using some kind of signal system trade off of rather than just sort of trading and winging it. You're not going to do well winging it. You're going to exhaust yourself mentally, and you're probably going to see your results get worse and worse over time. And even off that last exhaustion absorption combo, buyer exhaustion, seller absorbing buyers there, came right back off. It's going to look real nasty if we get another lower low here on this micro trend structure. Could start to look like we really are having more of an intraday reversal here. Just going to zoom out again because this does look heavy to me. You know, for a while, sellers were just pushing and pushing and pushing up there, not really getting far. But now they've been able to crack that point of control, and they're continuing to push. You know, it's hard to put too much faith in sellers, but they're actually doing some work today. Yeah, we're starting to crack to a new low here on the Nasdaq. Just going to pull up the heat map on my screen. It really is the AI beneficiaries that are getting clobbered today. Micron down almost 10%, AMD down 7.75%, Intel down nearly 6%, Applied Materials down 8.66%. It's pretty nasty out there. SanDisk, though, really leading the pack lower, down 16%. I think this thing's been cut in half from its high. Yeah, it sure has. That's a real heavy looking chart on SanDisk as well. And look, this is not a bad thing. Let's be completely honest about what's happening here. Everyone got super duper bullish on the AI hardware bottleneck. They got really, really expensive. A lot of presumptions were built in about where this was going to go and what the forward PEs looked like and how that suggested things were cheap. And they aren't cheap. And the forward PEs are making assumptions that may not come true. We don't know where this is going to go. I mean, what if, you start to hear that some of these companies are pulling back a bit on spend or slowing expansion, or other bottlenecks like power become more of an issue? You don't know where things are going to go. So when you see a parabolic move, and literally this was a parabolic move in a lot of these stocks, you can't just get into something like that and not have an exit plan. This kind of goes to the whole idea of my idea of an exit plan. What's your exit? Do you have a price target? Do you have a momentum indicator that turns the other way, like a moving average or RSI or MACD? I mean, what is your exit for a swing? It's the same thing you got to distill into day trading. You've got to know where your exit is. If you don't know where your exit is, you're gambling. I mean, let's just be real about it. If you don't have a plan, if you don't have a strategy, if you're just trading to get dopamine rushes, right or wrong, you're gambling. And you're going to have a bad time. But if you take that the other way and say, I don't want to gamble, I want to be more systematic, I want to be more consistent, I want to take some of the emotion out, I don't want to be glued to my screen 24/7 either, that's where the rubber meets the road, building a system, making sure that you're able to validate it with some honest back testing. And what I mean by that is not just back testing in a sim that's blind, but back testing where you're accounting for slippage, errors that can happen where your orders just don't get filled, commissions if they apply to you, the delays that can happen, because a sim is assuming everything's getting executed at that moment. But the reality is that a market can move so fast, you don't get your limit order filled at all. So those are the kinds of things you need to build into a realistic backtester. Once you've done that, and you can account for some of that variability, you can backtest and you can find signals that are more likely to be real. Not something that fires off with such a small window that you wouldn't be able to execute it. And even if you had an algo on it, if you weren't parked at the exchange, like co-located, you wouldn't be able to execute it. And you got to remember, there's a lot of firms out there. We're talking about multi-billion-dollar firms like Jane Street and Citadel. Their entire game is extracting liquidity from the market, and they are damn good at it. And they've got AI and powerful clusters of machines working on improving those same strategies, whether it's high frequency, but they're also starting to move into medium frequency. You'd say, well, Mayhem, isn't medium frequency like trading over multiple days? No, in their lexicon, medium frequency is trading over like multiple minutes or hours. High frequency is like, we're talking like milliseconds and sometimes shorter time frames, like really, really quick. But medium frequency trading is a lot more like what we're doing. And you're seeing more of these algos move in, more of these market makers move into this space as well. So it's a word of caution for us human traders. We need to know where we have an edge. We can only know that if we have a systematic, data-driven approach to back that. Because the other part of it that you've got to appreciate here is if you have the data, then you have the confidence to see the trade through. How many times you get into a trade and then you exit because you're like, oh, I don't even know. I'm going to second guess myself. It slightly moved against me. I can't do it. But if you have the data to back you, this is the probability of the outcome. This is where your risk is. This is your max drawdown. Why not see the trade through? Dial in your stop, dial in your exit, do an OCO order. It's much easier to stay calm in that trade. You've got the order, it's bracketed, You've got the data. You can sit back now and see if the trade goes through. And you know what's interesting about these systems is once you start to see them work, and again, it's not a guarantee that every trade will work, but you're putting the probabilities more on your side. Once you see them work, you'll have the confidence to see more and more of those types of trades through. And you'll take out a lot of the guesswork. So going back to the Nasdaq here, we did make a lower low. We're bouncing off that lower low right back to where we saw this, this decline start again. We see some stop outs happening from shorts here. Little bit of iceberg selling happening here, not enough to register on the chart, but you can see it on the sub chart. It's going to be another challenge to the point of control, I would guess. So we'll just zoom out a little bit so we can visualize the last time. Yeah, set it and forget it. Exactly like Steven said in the Discord. That's really what you want to be doing. Because I see people do this all the time. They burn themselves out, just like staring at every tick, overthinking the trade, just killing themselves mentally. This is going to be taxing no matter what, to some degree, because you're putting effort in. That's a tax you pay mentally. But why put more effort into something than you need to? And I mean that on like the intraday. You should put plenty of effort in your strategy, your review, your behavior, and making sure that it's something that persists. But then like just sitting there staring at every single tick for hours at a time, you're going to exhaust yourself and eventually burn yourself out. Not a lot of people can do that for long periods of time without, paying a bigger tax. And again, I don't want to see you go through that, because that's the other thing that happens. Like, let's say you don't blow yourself up and quit trading, but you burn out because of doing things like that. I'd rather see you avoid that. And there's many ways to do that, including setting alerts for signals. And I think as long as the AI beneficiaries are getting absolutely pummeled, the Nasdaq's going to struggle. And those same stocks are a pretty big chunk of the Nasdaq. NVIDIA at least managed to climb out of red, but the circular deals have people concerned again. It's in the headlines over the weekend and into Monday that NVIDIA is backstopping this data center deal for Stargate, for OpenAI. There's probably going to be more of that sort of stuff going on. Ultimately, whether it's good or bad or neutral is going to come down to whether or not these companies are able to scale and whether they're ultimately able to make bottom line money. OpenAI, Anthropic, a lot of these companies are cash furnaces. Some of it has to do with the fact that they sell subsidized subscriptions. Some of it has to do with how expensive the training is. But at the end of the day, if they're able to make their business plan work, a lot of the circular AI deal stuff is going to become a distant memory. On the other hand, if they struggle and let's say they IPO and it doesn't go so well. I mean, look at what's going on with SpaceX. Have you guys seen that? It's insane. I mean, it makes perfect sense. It IPO'd at over 100 times sales. That's not buyable. No rational investor will ever buy a company with that much risk at that kind of a valuation. Like, it can't even grow into that valuation over 5 years. It didn't make any sense. And there was all kinds of hype. Goldman, Morgan were behind the IPO, so they pushed it as far as they could. They put all kinds of stories out about how, this thing could be cheap here and it could be trading with, trillions of revenue in the future, all this kind of stuff. And it all sort of faded away. And now there's this sobering moment where the space data center company, which, by the way, if you unpack that in your head, space data centers, orbital data centers, it's a little further into the future than what the hype would suggest. It's not going to be easy to engineer that. There's going to be all kinds of issues that you have to deal with as a result. You're slowing the cadence of your upgrade cycle. You have radiation you have to contend with. You have latency you have to contend with. You have, a lot of issues. And then there's also just like physical security. What happens if an adversary wants to take out a space data center? How is it guarded in any way, shape, or form? I mean, it's a lot more questions than answers. Deploying that at scale, I don't think happens for many years. So you look at the more down to earth AI companies that are going to be IPOing, Anthropic and OpenAI. I don't know that that's going to be any different than SpaceX. I think the market's going to punish them if they come to market with IPOs at their absurd private valuations or higher. And so if they struggle and they're not able to convince investors and they start to see, more and more of their equity value decay, because you got to remember businesses use that as a part of the way they kind of keep operations going as well, that can be problematic. And that's one of the things that I would look at. And you could kind of see it if you read between the lines. All this advocacy against open models, Anthropic and OpenAI lobbying DC, doubling their contributions under the idea of AI regulation. What it really is regulatory capture, if we're being honest. When companies get big enough, they like to influence regulators to add regulatory barriers that keep competition out. And of course, it's being framed up as, oh, it's all those, models from China. But in reality, if you look at the way this stuff is all being articulated, even by Anthropic in their own letter that they released yesterday, they say they want all models that have a certain set of capabilities to go through safety testing. Now, they have the scale of company to satisfy those tests and to go through all that bureaucracy and for not to hit them as much. So do OpenAI. Smaller labs do not. They're not going to be that. They're just not going to have that well of resources to throw at bureaucracy without massively slowing down the company and making its viability much lower. The big guys know that. That's exactly why they want those kinds of regulations. It's not just, governing China and what they're doing with distillation, which isn't even really an attack, if we're being honest. It's also to slow down domestic competition. So if they're that desperate to slow that down, that suggests there's some problems in the business model. Maybe the idea that these large language models, these AIs that we interact with, are going to be commoditized and the companies that make them aren't going to really have strong margins. Maybe that is a realistic idea. Maybe that is something that's already starting to happen. Kimi K3 came out, its weights dropped yesterday. This is the most capable open weight model ever released. It's an incredibly powerful model. You won't be able to run it on your computer. It's huge. But it illustrates a point that China has narrowed the gap now to where it's almost imperceptible with the US closed frontier labs. And they're nervous. So some of that is translating here. I think that part of the risk off that's happening in the AI bottleneck trade, which again was very frothy, the valuations were very high going into this. This is okay. This is healthy. You don't want things like that to just keep going up and up and up ad infinitum. The folks that are whining about it are either too leveraged or have too short of a time horizon or bought really late or some combination of those things. That happens. It's what markets do. But I think that ultimately what's happening with AI is real. The progress is going to continue, and where it manifests itself in the market, where there are opportunities, that's going to continue to shift. That's part of the process as well. And as we took a glance away from the Nasdaq to talk a little bit about what's going on underneath the surface, not really a lot has happened since. Came pretty close down to the lows. We've just sort of been consolidating here. What I like to call this is building acceptance below the point of control, sort of the market accepting this lower range of prices here. And we can see in NDX, which translates to NQ with a bit of a delta, most of the put activity is closer to the lows of the day. And there is a lot more call flow going on than puts right now. Let's shift over to NVIDIA for a moment here. Maybe, maybe not. Uh-oh. Well, we may not be shifting over to NVIDIA after all, because that seems to have caused the renderer to stop rendering. Can't switch away either, so I'm going to restart this. Wasn't that something? I'm getting a unexpected error in Java environment issue here that I'll probably need to troubleshoot for a moment. So bear with me. Got this all under control. It's just going to take a moment to sort. So while I sort it, I'll continue to just talk a little bit more about my feelings on where this is all going. Long run, AI is going to end up being the most disruptive technology in human history by a lot. There's no doubt in my mind about that. The question is really, when do we start seeing AI that manifests in a way where it's truly disruptive to what we know to be our economy? We're not quite there yet in a lot of fields. There are some, like, you're seeing it in programming, you're seeing it in image creation and video creation and things like that. You're seeing it in data analytics these days. It's getting better and better and better at doing that sort of stuff. But I do think it's still going to take a bit to get to the point where it's as disruptive as it was initially advertised. And what I mean by that is, we're told, oh, AI is going to take everyone's jobs and it's going to just sort of like take over the entire economy and it's going to happen imminently. I mean, they kept talking about timeframes of like months to a year, and we're still not there. And we're not there because those timeframes were never reasonable to begin with. But a future where that happens is not impossible. And that sets us up for a pretty important decision, which is, do we want to have a future that is more like Star Trek or Star Wars? And that's what I kind of keep going back to. All right, let's see how this works now. I prefer the Star Trek future, by the way. So I did just pop in a upgrade. Every time you do that, there's licensing verbiage you've got to read and agree to. But it does look like we are back. And there's something weird in my session volume profile I'll have to look at later. In fact, there's a lot of weird rendering issues. Wonder what that's all about. That is pretty bizarre. See what happens if I just disable OpenGL temporarily. It didn't like that, did it? All right, I have another idea. I apologize for the technical difficulties, kind of out of my hands, but doing what we can to try to stage a recovery, as it were. Are we back? Looks like we're back. Real-time troubleshooting with Bookmap, brought to you live. Now it's just backfilling this data. There it goes. Still don't like the look of this chart at all. Really continues to look heavy to me. We're just zooming out here to about an hour time frame. Has that micro trend breakdown look to it. You know, the 2-hour looks like consolidation into the breakdown. Then we zoom out to the 4-hour. It continues to have that heavy look to me, especially when it was able to break below the point of control and had like a couple of attempts to break higher. Never was able to stay there and build any acceptance. And instead, we spent most of our time building acceptance below the point of control. So it does look like it's one of those double break Tuesdays where you get a kind of a violent reversal, and then even into that double break, you get another reversal. It's one of the reasons, again, I think it's wise to consider testing outcomes based on the instrument, the day of the week, and the time frame during the day. If you're intraday trading, you've got to be aware of what the difference is between trading between 9:30 and 12:30 and say 12:30 to 4. But yeah, I mean, if I had to wager where I think this is going, I think it's probably coming back down to at least, I'm going to say the low where the point of control was earlier, around 27,700. I think we give back a good chunk of this. It just doesn't look good underneath the surface. Some of the most important drivers of the rally year to date are under enormous pressure. So, yeah, the Mag 7 can kind of help to lift us off the lows, and they certainly have been doing a lot of lifting. I'm sure their backs collectively hurt after all this, especially Google, Microsoft. They've been doing a lot of heavy lifting today. Even SpaceX is up today, believe it or not. But up from where? I mean, it's only trading at 115. Where was this thing? Where did it ultimately get to? Like 227 change? 225.64. That looks like that's the all-time high. And it just looks like a rocket that took off and then went the wrong way. And it's still trading at a ridiculous valuation. Nothing against the company. I mean, I'd probably buy the stock if it was trading at a more level-headed valuation. And I'm talking about something closer to like 15, 20 times sales, and, you know, getting a better idea of what their plans are for some of these other companies they bought, like X and XAI. I mean, I get that they bought XAI, and I can kind of understand some of the rationale behind it. But the concern I have intermediate term is, how do you turn that cash furnace net positive? And I know they're leasing data center space in Colossus One, but becoming a neo cloud wasn't really part of the original business plan. It was supposed to be building really impressive models that would bring more customers in for their own offerings. And hey, if Grok 4.6 that's due out in early August is any good, that could help. Grok 4.7 is supposed to come out not long after that. That could be pretty solid too. All right, so let's see if we can go to NVIDIA here. Yes, now we can. Glorious. So you can kind of see that confluence area up there at 200. If the market, the majority of the participants in this stock had their way, there'd be a lot of transacting up there. You can see that because the most active call strike, 157,000 calls traded up there. It's also key 6 plus positive gamma level. It means a lot of call positioning up there existed before today started trading. And there's 478,000 shares on offer at 200. So big confluence area, 3 market generated information points telling us that if we did have a rebound, that's where NVIDIA stock would want to go. Let's take a look at it. Yes, it's looked a lot different than the Nasdaq today. We've been focused mostly on the Nasdaq because that's where a lot of the excitement has been. But ES does have a similar shape. That is to say, you did get that initial rally, consolidation. Then you started, your buyers initially pulled that point of control higher. It was looking constructive, but then you saw that slip below, that downtrend microstructure form, breaking out of consolidation to a downtrend. And it's just been struggling ever since. If I look at a heat map of SPY, I am seeing that some of these industrials are rolling over. So it's not in the S&P 500, it's not just some of these tech beneficiaries, the AI bottleneck trade stocks, it's also the industrials getting clobbered. GE Vernova down almost 6%, Caterpillar down 5%. These things had a really good run though, so seeing them pull back is healthy. This is part of the market too. You've got to kind of understand that you've got to shake the tree every so often. You've got to shake the tree. And what I mean is, weak hands who don't have a tight grip, they're going to get shaken out. They're going to exit their trades, whether it's fear, whether it's stops, whether it's margin calls, they're going to get exited. And when the thing starts to turn around, eventually move higher again, those same folks will be part of the people pushing it up as they buy at higher prices. It's a natural part of the market cleansing process. Also means, if you're not so sure about things, if you're getting risk exceeded signals, there's no shame in lightening up and looking for a better momentum. The goal here isn't to catch bottoms or tops. It isn't to ride throughout the entire storm. I mean, if you're an investor, that's a whole other conversation. We're talking about trading. And trading, time matters a lot. You're not going to be able to beat your benchmark if you're underperforming this badly, if you're holding on to losers over concurrent sessions. So you also got to, one of the ideas is limit the size of your losses and let your winners run. But when you're letting your winners run, you do know where your exit is. You have an understanding whether you're using like a close below a moving average or a change in relative strength or MACD or a certain price level. You've got to have that wired in. All right, we'll switch back over to the Nasdaq. That has been our mainstay for this session. Seems like it's trying to grind out a bottom here, but I don't trust it right now. One thing I will say, though, order book balance has improved a bit. There's definitely less of a delta between stacked offers and bids here. A lot of strength in healthcare, consumer defensives. There's a whole rotation into parts of the market where money thinks it'll be treated better during times of volatility. Even utilities got a bit of a bid. Those are the three places that money managers tend to run to because they have a mandate. They've got to keep a certain portion of the portfolio allocated to equities, but they can change their risk appetite by which part of the market they're getting allocated to if their mandate allows them. If they're more, sort of a generalist shop. So you can see folks saying, boy, I don't want to be in this high beta stuff right now. This just is violent. Selling that and buying some of the safety areas of the market, buying some of the more defensive places to shelter, even things, ETFs like a low volatility ETF or a dividend ETF, which, there's some interchangeability between the two as well. But that's interesting to think about because if you look at the difference between S&P and Dow, which are both green on the day, and Nasdaq, which is a bit red now, a reason for that is the dispersion underneath the surface. And it's that sort of rotational flow out of AI beneficiaries and into some of the Mag 7, which are kind of sort of seen as safety trades for some, and also into the more traditional safety trades of consumer defensives, healthcare, and utilities. Yeah, pretty much just consolidating here. But remember what the big picture is on the NASDAQ and why I have some concern with longs in the near term. And that's just we've broken below the point of control. We've made some lower highs and lower lows. We saw buyers get real aggressive trying to push this thing higher, and they just lost the plot. So each time we saw that kind of aggression pick up, sellers stepped in, pushed this thing lower. They ultimately took it to new afternoon lows. And when you zoom out on the day, it's one of those traditional double break Tuesdays. You get a little bit of both sides. You can see we broke below the opening range, the 20-minute opening range to the downside. Then we broke above it to the upside. And now we're starting to push right back into it and consolidate. There's not a lot to like in that setup. These types of setups tend to be more choppy. We've also got a lot of earnings on deck this week, so the market's going to see some strange things like just-in-time hedging. We've got folks putting on protection right ahead of events to try to reduce how much volatility slippage there is due to volatility selling strategies. So we've got a lot of big earnings coming up tomorrow. We've got the Fed tomorrow, and then we have more big earnings coming up on Thursday. I mean, this is kind of like the biggest big tech week for the market. And until those things are behind us, I don't think that this is going to necessarily give us much of a resolution. So to recap, tomorrow, Microsoft and Meta after the bell. Thursday, Amazon and Apple after the bell. And tomorrow we also have Warsh, who some expect might even deliver a surprise hike. I'm not in that camp. I think he'll talk a big game. There'll be more discussion about task forces and committees and looking into this and that and the other. But I don't think he's going to do anything in terms of moving the rates. He might talk more about the balance sheet, but I'd be very surprised. And hey, I can be wrong. Maybe he will. But I think it's more likely he holds for a while, tries to figure things out, and doesn't go in too heavy. The idea that he hikes is coming from a place of him building some credibility. But I don't think a surprise hike necessarily builds the kind of credibility he needs. So we'll see what happens. I appreciate you all joining me. I'll be back next Tuesday at 1:30 p.m. Eastern for the next episode of Back to the Futures with me, Markets and Mayhem. Have a great rest of your week and stay nimble out there, my friends.